Happy Friday the 13th, everyone. Today's video is, again, kind of a market update, just some thoughts on what's going on, calling it Appetite for Risk on Friday the 13th. I want to start with briefly a bit about the Fed. Yesterday I saw there was a 97.8% chance that the Fed would cut to zero next week, so the 18th, I believe it is, at the 18th when they meet. Chance that they would cut the rates to zero, which would be a bigger cut than normal, but given what's going on, or what has been going on, not impossible or not even unlikely at this point. Obviously, the market's saying that. The other thing about the Fed is that yesterday they came in with a big money bazooka, is what I guess they called it, and so they are printing, or have agreed to supply a whole lot of liquidity, and during the day yesterday that satisfied the markets for a whole 5 minutes or so, and then it didn't. The zero bound that I wanted to discuss is sentiment. Sentiment, the CNN Fear and Greed Index hit 1 out of 100. 1 out of 100. That's pretty bearish, pretty fearful, I guess you could call it, which is pretty extreme and thus potentially bullish, at least in the near term. AAII sentiment survey, that was 51% bearish, almost 30% bullish. And again, that's fairly extreme. It's still a lot more bulls, and that's from Wednesday, by the way. That's a lot more bulls than I was thinking, although there's always a lot of bulls. So, yeah, I mean, it's fairly extreme, I guess you could call it. Are there bargains to be had? Well, I believe so. At some point, looking around at a bunch of things at today's prices, at some point, they probably will look cheap. Whether that's tomorrow, next week, next month, next year, I don't know. But there's a bunch of sectors that are beaten down on top of beaten down. And now I was looking closely at oil. I started looking closely at oil heading into when Saudi decided to do what they did. But you know what? Like I was looking, and all of energy has been so beaten up, like along with oil, and many others fundamentally aren't as beaten up as oil. But you look across the board, nat gas, coal, uranium, everything just kind of dumped out. With heck, even the renewable stocks, which are the market darlings, were just dumped out recently. And oil has been hit harder, but some of the others were hit almost as hard as oil, and I mean, it seems at least, and their fundamentals aren't actually destroyed. So I'll get to a few ideas there in a sec, but just looking around the whole space, everything just crushed. On the other hand, they were crushed early and have recently actually been holding in because their fundamentals are improving very rapidly, especially with the new Saudi move, with the oil oversupply or whatever. The tankers being used for storage are getting close to printing money. If you've seen the VLCC rates recently, that is not normal for this time of year. The stocks aren't going up. My theory there, most of the stocks are just not going up, as the tankers and product tankers also. They're not going up because the market does not look like it has an appetite for risk in days with the massive sell-off. And these things are cyclical, they're risky, and they have a lot of debt. And so the market is like, well, why should I buy this when I'm not sure how long it's going to be making money, when I could buy, I don't know, Boeing down 18%. That was just yesterday. That was just the thing I remember. I'm not buying Boeing right now. It's not really interesting to me. But that's not to say it's not a buy. Anyway, the tanker rates are very seasonal. October is a good time. Now is normally not the greatest time. It's but this year seems to be different, at least for now. So we'll have to see how that plays out. But realistically, these rates right now are higher than they're supposed to be. Thing that is hitting a lot of things, even everything, I guess is the best way of putting it, is valuations. Now, you have to think of it this way. Even though you own a cheap stock, the people that owned expensive stocks thought they were cheap or thought they were worth buying. So when the expensive stocks look less expensive, are they suddenly going to go and buy cheap stocks? No. So they'll buy the less expensive stocks because they think of them as more expensive. So when the valuation goes across the market, when the valuation goes down, every single investment type has more competition from fellow investment propositions. So like, if you have a company trading at 5 times earnings, you have another one at 10, the one at 10 goes to 9, and the one at 5 goes to 4.5. And they're both down 10% in their valuations, so it's the same type of proposition, only they're both down. So that's the type of thing that I see kind of going on in the market, and that's why everything kind of just gets crushed. Something I think it's important to realize at times like this is the difference between risk versus price. So if you look across the board, you look at a bunch of companies and balance sheets really, is some companies have just gone down because the market's gone down, and some companies are repricing risk. Look at Google, for example. They have Alphabet, sorry. They have $100 billion in net cash. They're not going to go away due to market conditions, or they can weather any storm. And you know what? If every other company around them sells off big, well, that's a big opportunity for them to use their $100 billion in net cash. Versus all the other companies that are highly levered, buy back shares at triple the current price, and have tons of debt. Now that the risk has arrived, they are cutting their dividends, uncertain to survive in a few cases. Obviously, I have plenty of companies that have just been hit because they have debt and will survive. But now is the time, or the risk time, when all the other companies are falling apart, is when it probably would be nice to have cash. And you know what? Worst case, everything's falling apart, everyone's panicking. Now is when you buy back shares. Okay, so in sectors, in gold miners, wow, they're selling off a lot. But you know what? The interesting thing is oil is a big input cost for gold miners. So in theory, as long as gold stays above, I made this slide a bit earlier, and then gold miners sold off like crazy. And now, given the current price, if gold stays above 1350, some gold miners look cheap, but if it stays above 1500, by the way, it's on 1570 or whatever. But if it can stay in this region, then the gold miners begin to look pretty cheap, especially when with oil this low, and their costs could surprise to the downside. Some look, the ones that are in production and have cash flow right now, you just look across the board, and they're kind of, if they could do anything close to what they say they're going to do, they look pretty cheap. Next sector, uranium. Uranium versus uranium juniors. I say this because as of yesterday morning, I looked, and Kazatomprom was flat. Like over the past month, it was like down 1.5% or something. It's basically unchanged. Why? Because uranium is basically unchanged through this whole time. Nothing has really happened to the price of uranium. Oil's down 40% or something. Based on supply and demand dynamics, uranium honestly, what has changed? And the answer to that for me is not much. Now, the one interesting thing that happened yesterday that I just wanted to point out, because I spoke about it kind of a few weeks ago on Twitter, mentioned that something like this could happen as kind of a potential out there event. But yesterday, Kazakhstan first, and the ordering of this I found funny, but might be completely illogical, who knows. First, they shut down all public events in Kazakhstan, which I found really interesting because they did not yet have any confirmed coronavirus cases. Then, they confirmed 2 coronavirus cases. So, 2 cases, shut down all public events. Interesting. But the reason I mention this is simply that if they need to shut down industry, for example, there's 20,000 people that work for Kazatomprom who mine about 1 million pounds of uranium a month, and 5 million pounds of uranium per month. And that is something that could make a difference. Now here is a list of investments or trades, depending on that case, that I'm looking at, given current prices. And there's a lot. And my preference keeps shifting because every day one's down 20% and the other's only down 10. Say that semi-sarcastically, but you know, if you've been watching the markets recently, it's not that sarcastically. Anyway, Altius, royalty company, I spoke a bit about it earlier, and I mentioned in the previous video that I had lowered my targets on things that could be hit by the coronavirus. So I did have a higher target on Altius, but I moved it down, but now it is looking pretty interesting. So that's a diversified royalty, not gold royalty, diversified, and it's looking cheap. Shipping, in the shipping space, we have Ardmore and Scorpio on the product type side, DHT, and I can even throw in some others on the VLCC or dirty side, I should say. Gold, I mean, at this price, Equinox Dynacore was hit yesterday, but before that it held in remarkably well, I found. But yesterday it just died. So yeah, those in the gold space, Global Atomic, bought a bit of that. That's one of the only things I've bought so far, aside from the other. Well, I bought some DHT. I bought a few of these things actually. Now that I think about it, Global Atomic, still want to buy some more of that. Below 30, wow. I'm gonna buy some more of that. Minko. Okay, so you're thinking, okay, I know all these other things, but Minko, seriously? Well, they have 50-something cents of cash in short-term investments, and it was trading at 35 cents yesterday. I bought some. Now, it would need to go up 50+% to be trading at cash value, so, yeah. Then we have oil. Each oil stock is cheaper than the next, I'll be honest with you. I just look and I'm like, I'm looking at Suncor, CNQ's mixed. Whitecap had some big insider buying. I was looking at Vermilion, but I had some insider selling. Didn't like that. Wasn't much, but I like watching insiders because they kind of tell you if there's something to be concerned about, and all across the board, there's so many cheap stocks. And then Stelco is a steel company. Now you're thinking, why would you want to be looking at a steel company now? The answer is simply price. Because this is trading at 1.5 times cash, and it's trading at what, 355 Canadian a share, and it was trading at $27 a year and a bit ago, and this is a company that paid $1.50 in dividends last year or 2 years ago. Ugh, I'm having trouble not buying a lot of that one. And then you have other energy plays, and other energy plays like tourmaline and Cameco that were just, well, one's tourmaline is 80% natural gas. There's some other natural gas plays also, and in the US there's Antero, which if they survive, they're at 0.05 times NAV. So it's an interesting call option there. But the point is, everything has kind of been chucked out with oil. And Cameco and Tourmaline are examples of that, where they are big Canadian $2.5 billion, 2.5 billion Canadian dollar companies that are energy companies and are just no interest. So in times like this, I want to reiterate something that I've said a few times. Know what you own, know why you own it, know what your risk is, know what the price is, and the answers to what should I do became clear. And the other thing is know your time horizon. Know why you own a stock, how long you plan on owning it for, and what your plan is. And the answers to what should I do, what should I buy, what should I, whatever, they'll come to you. And very crazy recently, the speed at which the market has been going both up and down, mostly down, but both, has been crazy. The other thing that I think is important to remember, even though I think it's fair to start calling this a crash. And no, I'm not joking there. I mean, like, the speed at which it's moved, I don't call it 10% a crash. I wouldn't call 15% a crash, but at 25%, I think it's fair to start calling it a crash. And it has moved very quickly. So I don't know if it's over, but it is kind of crashing, or has crashed, or is crashing, will crash. I don't know. Tense is up to you. But the market was lower 15 months ago. So, and that's something to remember. If you look at commodities, there's been a variety of different outcomes, some, depending on the commodity. Some have been killed, some have been concerned, and some have been sleeping. And so I've really been surprised, or not surprised, but I'm really fighting the urge to say surprised how well certain commodities have done or held up, because last week I said that, and oil just said hold my beer. But some of the metals have been doing decently. I mean, they are down significantly, but it doesn't look like the economic impact has been catastrophic thus far in many cases. There are a number of beat up sectors that are more, I guess you could call it, mainstream than commodities, that are getting are different degrees of interesting. Look at the airlines and cruise lines, for example. They just got beat up. I know the cruise lines got very popular on YouTube around $40 like a week ago, and now they're at like 15. That's crazy move for something like that. But you have to remember, these are cyclical industries. And you look at some of the cruise lines, and they were spending billions and billions of dollars on new ships in 2018, 2019, and you know what? Now the ships come, growing supply at a time when, well, demand is projected to grow, but not now, I guess. And so they probably were due for a bit of a cyclical downturn. I don't know if it's overdone or not. I guess the cruise industry will probably grow eventually, but near term, don't think so. And so these are things with big, high fixed costs. They will probably lose, not make no money, they will probably lose money in the near term, and they could lose a lot. So the ones with cash and manageable amounts of debt will probably be fine and will probably be a buy at some point, but it just seems way too early to look into the future and see the turn. I mean, maybe it's turning, but near term. Near term, I mean, I don't really look at near term with investing, but near term, these things are going to struggle to make money. Forget about the share price. I don't know what the share price is going to do, but once things start cooling off, they could be interesting buys because these companies, these industries are going to be around in years, unless we move to electric teleporters or something. I don't know. Yesterday, I was a bit early with my tweet about lighting money on fire, so that was, I guess, ill-timed. Everything seemed short-term very oversold, very beaten down, and then it got even more beaten down, even more oversold. So it's hard to judge long-term things in short terms. It's hard to judge short-term things when emotions get to extremes. I have no calls for today, one direction or the other. We are pretty oversold. The one thing I can say is the less money I have, the more real it feels, because there has been a significant haircut all around, and so risk is more priced in. That's what I'll say. I have no idea if it's over. No idea. But with the market up 6% near term, the feeling that, oh, it's a probable buy is, well, less certain than ever because of how fast things are moving. So bottom line, this slide, no calls this week, no calls right now. Things are moving very quickly. Things are changing very quickly, and I don't know short term. Two semi-off-topic points that I wanted to go into before I wind down the video is my idea, my informed or semi-informed, I guess you could call it, because it's me, way of stopping the coronavirus. The best way, the most effective way I can think of, is to do what China did. Now, you don't have to just do it overnight. You could say, okay, so on Tuesday, for 6 weeks, we're going to lock down until we have the coronavirus contained. Give people time to shop for food, get what they need, and then lock down. And I know this will suck for a lot of people, but the problem is if we only half measure contain it, then the economic impact just continues and continues and continues. If things are just paused for as long as, if things are frozen, if everything's completely locked down, frozen, we'll get over it very quickly. But if this kind of trickles along and half businesses are shut down and there's no big public gatherings, but there's small public gatherings, then this is just asking to slow it but not contain it, and it's just going to keep going and keep going and keep going, and it could have very serious long-term consequences. So, yeah, how to stop it? If everything got completely shut down for a while, I think we make it to the other side simply, but if things get half measured along the way, this could continue to be painful. One of the things that I just kind of wanted to mention here, and something that's bugging me in the markets right now, is all this talk about bailouts for like big business or like airlines, cruise lines, or whatever. And my thought goes a little something like this. It's not right to bail out privately owned businesses and let the owners keep ownership. If the businesses can't manage their balance sheet and are wiped out because they can't do business, well, I'm sure the government can save the business if it wants to save the jobs, but it needs to, the only morally right way to do this, in my opinion, is to kind of take control of the company. And you know what? IPO it in a few years once it's back on its footing. But you can't bail out private businesses. These are things that pay dividends to their shareholders. They sometimes either they're a good enough business to have a solid balance sheet, or they took risks, bought back their own shares with lots of debt, and might not deserve to remain in business. Now, obviously, there's some exceptions, but the current policy and the current framework in markets is stocks taking too much risk, keep having tons of debt on the balance sheet so they can buy back shares. If you want to take a risk, don't, expect a bailout. But, there's always talk about these things in times of trouble. And, this is just my opinion. But, hey, that's all for today. I hope everyone enjoyed. Remember, none of this is investment advice. And with that, I will leave you on Friday the 13th. Enjoy today and your weekend, and good luck in the markets next week.